it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate.
Basically, he said today, look, I don't care what it takes. I don't care what's going to take place in the unemployment rate. I don't care what's going to happen with the stock markets. I don't care what's going to happen. We are getting this back down to 2%, even if we got to continue to raise. And now people are projecting, we're looking at another probably 100 points, 125 points before the end of the year. And Jerome Powell even sort of alluded to that earlier today. So another 1.25 percentage points up before the end of the year. Join us today to really break this down for you, CEO of Reaper Financial, Patrick Reilly. Patrick, welcome back to the show. There are so many things I want to visit with you about in regards to this announcement today. And of course, we want to focus on the people listening right now. So for the mom, the dad, the grandma and grandpa listening right now, what's the most important thing they should take away from the announcement today from Jerome Powell?
So I had a few key takeaways from today's announcement, and I watched through the whole speech, and the one that got me most was a question asked after he was done speaking about the rates by 2025. And Chairman Powell said that if the rates were down at 2.1% by 2025, that would be a great thing. That would mean that the economy performed well in going down to that point. So that means he's predicting 2 to 3 years of this continued pain and raising of rates.
When you say rates, you don't mean like the interest rates. You're talking about, he's saying inflation. He's saying, hey, if inflation's at 2.1%, that might be okay, right?
Yeah, if inflation's at 2.1% by 2025. So, and the way that the Fed combats inflation is by continuing to raise rates. So he is anticipating that we will have continued basis point raises until we start to see a reversal and a slow decline to 2% as the Fed's goal. And that could take as long as 2025 or longer, because he did show his poker face a little bit there and let slip that he thought that was an optimistic goal. So the other takeaway I had from this, and he repeated it a few times. I'm drawing a blank now. I had it in my head. So he was talking about stabilizing the job market and the supply and demand of jobs, and that right now we have a lot of demand for hiring and not enough people to fill the market. So basically, what the Fed needs right now is for unemployment to go up to stabilize prices. As long as the workforce is saturated and people keep getting jobs and people can get work, inflation isn't going to slow down. So they need to stratify the economy, and what that essentially causes for mom and dad at home and the people caught in the middle. What we'll see over the next couple of years is we'll see the lower class are going to start becoming poor by comparison, and the rich are going to get richer. So as always, any kind of economic crisis, you're going to see the rich get richer and the poor get poorer.
So what does that mean for us? Are you suggesting that this is being done? I mean, they have to see what's going on, right? Is this part of a process to say, okay, like the poor are going to get poorer, but the government will come in to save the day? I mean, the rich and the U.S. government, which we're going to get into this conversation in a moment about how in the world are we going to end up paying our interest payments. But the rich and the U.S. government, they love the inflation because it makes their debt less and less and less as the days go on.
Yeah, absolutely. For those that are in charge of the money and those that understand the money, this is a golden opportunity. This is a time when, for instance, and I am pursuing real estate investing, I expect a lot of foreclosures in the next year or two because of the raising interest rates and because of forbearance from COVID-19. So that's an opportunity for me, understanding that there'll be all of these foreclosed properties out there that I can go out and scoop up. That's obviously not a good thing for the people it's foreclosed on.
So let's talk about that. Again, if you're just joining us, CEO of Reaper Financial, Patrick Riley is with us. I want to invite you to check out his website, thereaper.io. Again, it's about decentralized finance, thereaper.io. That's something we'll get to towards the end of this conversation as well, and why that's important for you to really understand now, considering what's happening with some of the other developing countries' economies, their central banks, and where this thing seems to be headed. So walk us through the foreclosure perspective, because, a lot of people locked in 30-year rates, I would presume. Maybe they didn't. So why do you see a lot of foreclosures on the horizon?
So there was as many as 1 million to 7 million homes during the COVID pandemic where people were doing forbearance and or different programs with their bank where they would push off their payments. So there are people we're starting to see here in Texas who are being foreclosed on, where some of them are over 6 figures in debt on their mortgage. We're talking about $80,000 to $130,000 of debt on a home that's only worth $450,000. And that's just what I've seen personally. There's many other real estate investors here in our group that have seen other scenarios. And the problem is they put these payments off, and because they could not be evicted during the pandemic, they just didn't pay them. They thought they'd make up for it on the back end, and unfortunately, that's just not a reality or a good strategy.
Knowing what you know about what's going on in the economy, these rates continue to go up. I have touched on it a couple times here with the U.S. debt. I mean, the interest payments alone for the United States of America are going to be more than we spend on the entire defense system in an entire year. What's your biggest worry? Like, as you look over the horizon, you're going, hey, Chris, people better be focused on this, because this is going to be a major problem.
So I wouldn't even say it's a worry. We're going to be at where we're going to have roughly $1.6 trillion is my own personal estimate of what we'll be at for annual interest payments, which is nearly 50% of annual taxation. So our interest payments will be quite out of hand. I do, however, see a financial reset of some way, shape, or form in the near future, probably within 5 to 10 years. And I think as crazy or as almost conspiracy as that may sound to some people, with the US CBDC executive orders in place and President Biden's recent guidance through executive order on regulation of cryptocurrencies, we're going to have a completely different system monetarily in this country, in which the Federal Reserve and the Treasury will have a lot of other options. And included in those options will be different ways to bring down that debt or eliminate that debt.
Patrick, I want to have you back to talk about that, because there was recently a House Finance Committee hearing when all 5 testimonies, all 5 people that were there to testify, all 5 of them said, yes, the U.S. should have its own CBDC, which is the centralized bank digital currency, because they want to compete with China. Want to give you a chance, because it is reaper.financial. I know you changed the URL recently, so reaper.financial, but just help people understand what that is, why they should reach out to you, and how they can reach out to you.
Yeah, great. So reaper.financial, what our company does is we have our own token, which is a utility token, and you're allowed to vote on the blockchain for other tokens out there that we go out and purchase, and we permanently destroy them. So that's very similar to, actually, I want to segue back to the Trump lawsuit from earlier, but it's very similar to what Louis Vuitton does, which is it buys up all its unsold handbags and it destroys them so that it preserves the value of the handbags that are out there. They probably spend $50 to $100 on them, and they inflate that asset price, just like Donald Trump would with Mar-a-Lago, because it has a Trump brand and name on it. And they sell that for what they think it's worth, and people pay for it. So that's my take on the lawsuit. It's probably a big nothing burger, because he's selling the brand. He can value that any way he wants to. But
Patrick, I'm sorry, we got to leave it there. We're coming up on the break. Stick around. We got